Today we'll talk about how you can buy a business with a whole life insurance policy. I recently met with someone who is interested in buying a business with a whole life insurance policy. He's interested in funding his policy with a lump sum of money, and he plans on using the cash value to purchase a business within the next 30 to 60 days. His first question was, is it possible? Can I get the policy that fast? The answer is yes. However, there's some things we definitely want to be aware of. We want to be aware of what is the cost to borrow in that first year, especially when we account for the fact that he is going to lose money in the first year, just when you look at the structure of a whole life insurance policy. And we still want to do our due diligence in terms of looking at different companies and products, meaning he's got a short time frame. We don't want to rush the policy sale too quickly, because if he gets a product that he doesn't like, that's going to result in buyer's remorse. So we'll look at how we can use the policy to purchase the business. But first, we'll go through the product itself, how it's set up, but we'll start here. So if you are getting a policy and you plan to use it for business, a question that comes up or should come up is ownership structure. There's a million different ways that you can do this. The type of business that you have, meaning is it an LLC, is it an S Corp, is it a C Corp, that's going to play a role here in your decision. I'll go over what I've done with this before in the past. So the business he's purchasing, let's assume it's an S Corp or an LLC. Should he own the policy personally, where it's in his name? Should the company own the policy, call it the LLC, or should he have a separate management LLC? Here's what I did. The first large policy I got was a personally owned policy, meaning it was in Steve Parisi's name. However, I used that policy for business purposes. I also used my business to fund the policy at one point in time. Now, my business was a pass-through entity. Pass-through entity is an LLC or an S Corp. What that means is that personal policy was in my name. If I took money from the business to fund the policy, call it 10 grand, just to keep it simple, I put 10 grand into the policy. However, the 10 grand that was paid to the policy was not a write-off as a business expense. You can't do that when you're building cash value. It was passed through as income to me. My CPA booked it as a distribution. So if I fund a personal policy through my company, specifically an S Corp or an LLC that I own 100% of, it's passed through as ordinary income or a distribution. What if the company owns that policy? Well, if the company owns that policy and he owns 100% of the company, it functions in a similar manner. So if he puts 10 grand into his policy that the business owns, it's still not an insurance expense. What happens is it shows up in cash value, but it doesn't get expensed. It still hits the bottom line in terms of revenue and or profits, where if the 10 grand was going to be there, if he didn't put it into the policy, he dumped it into the PUA rider, so for the most part it shows up in cash value, he's still gonna have to pay income tax on it as if it were income, because I cannot expense my PUA payments with a pass-through entity. Now, with that said, the company, if he owns 100% of it, he can access the cash value in the same manner he could if he owned the policy personally. If he has a partner, or if he ever planned on taking on a partner, that's a different story. Where usually what we see is people do not want to have a company own a policy that is going to be their policy. They plan on using it for personal use, but if it's owned by a company and there's partners, and they own a percentage of that company, you can see where that gets a little bit sticky. So that typically is not advised. That's usually where this comes into play, a management LLC. So as things have progressed over the years, I've got a management LLC. What happens here is my management LLC owns a policy, funds the policy. The beneficiary of that life insurance policy is one of my primary companies, IBC Global. That serves as key man insurance. Also, as I build the cash value, it is on the management LLC's balance sheet, but I can access the cash value however I'd like. I can put a collateral assignment on the cash value with a bank and assign that to IBC Global if I want to be able to access the cash value. There's ways I can use this for my primary business. But why it's owned by the management LLC is because my attorneys advised that, and the reason why is in the event that I ever take on a partner with my main company, which I did. Now this is separate, and I don't have to account for the cash value that I owned before I took on a partner. Afterwards, it gets sticky. It's separate. It just keeps things clean. And you be upfront with your partners beforehand as well with all of that stuff. But that is why we've got that separate LLC that controls the policy that I want it owned by an LLC and not me personally, because this is for business purposes, but it just helps me keep things clean and still purpose it for business. All right, a lot of info there. Hope it made sense. Very, very important though, and very, very beneficial to get things right from the start. So in his situation, he's interested in how he can fund a policy specifically with a lump sum of $1 million. He had the question, should I just put it all in up front? The answer is no. That's actually going to be one of the least efficient methods to fund a policy. You'll see that he is in his early 40s. It makes sense to spread it out over 3 to 4 years, which if he does it 4 years, it's $250 per year for 4 years. If it's 3 years, it's a bit more. I'll show you both. Now, he would also like to see the highest cash value at the 10th, 20th, and 30th year. He is looking at this from a long-term perspective, but he also values the upfront cash value so he can use it to purchase that company, which he's very interested in. Now, he also wants to use a quality company, specifically a company that banks and corporations use, which would be one of the 4 major mutuals. Cannot go wrong with them. We're going to look at 2 of them, Mass Mutual and Guardian. The other 2 are New York Life and Northwestern Mutual. We'll also hit on the loan interest rates with them as well. So, what to look for in a policy to know that it's set up correctly. First year cash value should be somewhere between 80 and 90%, and the break-even point should fall somewhere between 3 to 5 years. If you see that, your policy is likely set up correctly, meaning cash value up front. You also have the most cash value long term. And the big thing is, if you're funding with a lump sum, you carry a very, very low minimum premium, which means it can keep on growing without you having to come up with money out of pocket to pay the premium. You'll see what I mean when we look at the numbers. Now, the company product and choice. We want to do our due diligence here. We're going to look at 3 different options that we walked through with him. The 3 of the more popular options. Now you've got these different smiley faces and sad faces here. Green, which is the happy face, is good. Purple is okay, and then red is bad. We don't want red, preferably anywhere. And his question here is, how do I get the most out of my $1 million? Because I want to get as much cash value as possible and then use that cash value for the business. So, starting with Mass Mutual, we looked at their 10-pay product, which produces the highest overall cash value when we look at the 10-pay compared to all other Mass Mutual products, especially when you design it for cash value as the priority. So Mass Mutual's 10-pay product, in terms of upfront cash value, is very attractive. You can often get it very close to 90% of what you pay into the policy in the first year alone and have a break-even point, in many cases, right around year 4. If we're older, maybe we have some health issues, maybe it's between years 4 and 5, but you can see very rich upfront cash values. Long term, this product often produces the most cash value compared to other products offered by Mass Mutual. Flexibility, however, is okay. With Mass Mutual, if I want to make it very flexible, where I can make additional PUA payments without the need to go through any medical underwriting, we'll usually use a combination of their AILR rider, which stands for Additional Life Insurance Rider. That is their pure PUA rider. And then also their LISR rider, which stands for Life Insurance Supplement Rider. That is a combination of a 1-year term rider and a PUA rider. That's the key to being able to scale PUA payments up and down without any medical underwriting. Technical, but the main thing is we just want to make sure we have those 2 riders on there because it builds in a lot of flexibility. So you don't get stuck in a situation a few years into a policy, which has happened when people don't add both of those riders to Mass Mutual policies. But overall, solid product there. Then we've got Guardian. we looked at two options here. First, we looked at their 10-pay policy. The upfront cash value is okay. Why it's not great is because that 10-pay product forces a higher base premium than all other Guardian products that are available. Meaning, with a life insurance policy, I can pay money toward what is called my base premium, which does not show up in cash value in the first year in most cases, or toward my PUA rider, which does show up in cash value. So the name of the game is pushing my premium as low as possible. So I put it at $1,000, and then knowing how much an insurance company will allow me to pay into PUAs in excess of that premium. So with all Guardian products, I can pay 10x the base premium per year. I've got to have specifically a 1-year term insurance rider attached. The first year I can actually go up to 50x, but aside from that, I can do 10x per year. That's the most we can illustrate. The exception is the 10-pay, where the most we can illustrate is the first year 50x, but then all years after that, if I have a term rider attached, 5x. If the term is not attached, I'm subject to their default PUA rules. If you want to know what those are, leave a comment below. I'll include a link to one of our videos that go through that. But the 10-pay forces a higher base premium. So as a result of a higher base premium, I've got a higher minimum commitment, and my upfront cash value is not going to be as attractive. That's why we have it okay. Their long-term cash value, however, with this product is the best compared to all other products. And then flexibility, I have okay. Guardian's fantastic with PUA flexibility because you can add it to the policy anytime you'd like, meaning you're committed to the minimum only. And then PUAs, you go on your online portal, mail in a check, wire transfer, you literally just send the money in anytime you want. Extremely flexible. But because we're committed to a higher minimum premium with this product compared to others, I put it at okay. Whereas the L95 product is fantastic for upfront cash value. With one of the designs, you're going to see more than 90% in the first year. Long-term cash value, however, is okay. It's not as attractive as the 10-pay product. But the flexibility is fantastic because I can commit to a minimum premium only and then add more money at my discretion. So a lot of people feel like it's simple, like they're committed to a small bill. If I'm using it for business, I don't want to have a big bill that feels like a burden. No, I'm going to be able to commit to the minimum and add more PUAs at my discretion. So a lot of times people are torn between these two, but we see most people still gravitate toward this one because of the upfront cash value that they can use for their business, and their business is where they're going to drive the highest returns. All right, let's take a look at a comparison of these, shall we? So first, we've got the 10-pay policy. Up top, you see the minimum premium, $25,000. That is what he would be committed to on a yearly basis, but he can fund up to $250,000 per year. So he wanted to get a total of $1 million into the policy. There's the break-even point, year 4. The health rating that he'll likely receive will be a standard non-smoker rating, not a preferred rating, which is what all of these numbers are run on, both MassMutual and Guardian. After the 4th year, he pays nothing, and the cash value keeps on growing. We drop the death benefit after the 7th year, because that's the earliest we can drop it without triggering a modified endowment contract, which is another name for a taxable event. But by dropping it, you'll see the cash value take a nice little jump there in terms of the annual yield, and it just cooks over time. Then we've got the Guardian 10-pay product. Here we go. So, what was the drawback to this one? The upfront cash value. Now, what we did here, look at this. Because Guardian allows us to put up to 50 times the base premium and PUAs in the first year, and then it's 10x per year thereafter. With the 10-pay, it's 5x per year thereafter. We're taking advantage of that first year, and not quite going up to 50x, but we're adding a lot of extra money. So if my minimum is 50, that means I put in 450 in the first year into PUAs. But the upfront cash value, the lump sum, it's not bad. If we did the same thing we're doing with the Mass 10 pay, it'd be closer to about a 17% loss, which is a big hit, especially when you're looking at a deposit of this size. Break-even point between years 4 and 5. Not bad at all, though. And when you look at it long term, the Mass and Guardian example are very close to each other, which makes sense. They're similar products. And then you've got the L95. So where this is appealing is when you look at the upfront cash value. Remember where we said it's greater than 90%? Here you go. So first year, your cash value is what? 460, and you paid in 500. That's a loss of a little bit less than 8%. The second year, you add 250 to it, you get your 250 back, and more on top of it, the net yield that year is 2%, and then continues to accelerate from there. However, you'll notice this one never reaches the 5s. Doesn't even reach 4.5 long term, whereas the 210 pay products do. They're designed for better long-term performance. But our minimum's 25 with this. We can add another 225 per year and a bigger lump sum in the first year. So we've got a lot of flexibility with this guy, which is why people are often attracted to this, along with the rich cash value up front and the break-even point, which is just about year 3 in this example. So from a business owner's perspective, where they're interested in the long-term growth, but they're more interested in not taking a negative hit on the balance sheet or profit and loss statement, and they want access to this cash value for opportunities that are really going to earn the high returns, much better than what we see in the policy, that's where this one is typically attractive to a lot of people. So let's look at this guy and focus on the flexibility, and then we'll look at the model of using the policy to purchase the business. So the L95 product, flexibility. This one's huge here. Here's the same policy. There's your first year cash value, pays in 500, he's got 460. This just gives you a breakdown of the minimum and what's going into PUAs. If this is you, you would be billed for this. And then this could be added at your leisure by going on your online portal or your mobile app. And you just ACH transfer funds from your bank account to Guardian. Same is true when you take out loans. So it's very flexible. What we have first is what he asked for. Show me what it looks like if I get a total of 1 million in, but say it's spread over 10 years. And I'll get the 500K in the first year, because the business that he's purchasing is going to cost him about $375 to start. That's what he needs in terms of cash initially. So this accomplishes that. And that low amount of $50,000 per year is something he knows he can hit. But then we see what it looks like if he funds it as planned. So this is the exact scenario we looked at on the last page. $1 million over 3 years, with just about $1 million by the third year. Very cash-rich policy. And then he asked, hey, what does it look like if things go well and I can keep on feeding the beast? So here, what he's got is 500 in the first year, 250 the next 2 years, that's his 1 million, but he can keep paying in 250. He said, probably not longer than 10 years. If he wants to go longer than 10, he can with this. But he said probably not. So we stopped it after 10 years just for the hypothetical. And that just shows a lot more money going in. And again, this is that L95 product. He could do the same thing with either of the 10-pay products. If he wanted to go longer than 10 years, that's where that L95 might make a bit more sense for him. But we're seeing different scenarios. And just to be very clear with this, these all display the exact same policy set up in the exact same way, but what the numbers look like if he adds extra money. It's up to him. He doesn't have to follow any of these schedules. Typically, we set it up where the only amount that is scheduled is what we see in red. Sometimes it's a little bit higher when we add the term rider cost, but we commit just to the minimum and then add more at our discretion. Because when people are on the hook for these big bills, is typically when they get stressed out or they can't do it. All right, using the money. You like the 10-pay a lot. So here's the 10-pay product that we've got in here. And what we're going to look at is using this for a loan. So first year, your cash value is $432,000 and change. The maximum loan that you can take is usually right around 95% of whatever you have in cash value. So notice we're at 411 here, and your cash value is 432 and change. It's less because that's 95% of the cash value. Now, before we plug in a loan here, Guardian's loan interest rate is fixed at 5%. If you pay the loan interest annually, which he 100% plans on doing, it is discounted to 4.76%. Mass Mutual's loan interest rate for May was 5.73%, I believe. For June, it's 5.23%. I think May was 5.76. It's a variable loan rate. They also offer a fixed rate at 6%. Guardian is fixed, so it makes it quite simple. So we've got the loan interest rate here, but here's what I really like to highlight for people. Even though the numbers are there, I still like to talk through this because it's people's money that we're dealing with. First year, yearly cash value growth, negative $67,000 with that 10-pay product. What does that mean? It means if you don't borrow, you take a loss in the first year. The second year, the yearly cash value growth is about $2,900. Where did we get that number from? That's 0.42%. The first year, you were at 432 and change. You paid $250. You got your $250 back, plus a little bit more on top of that, another $3,000 to be precise. This column is showing him how much money he is receiving from the insurance company on a year-to-year basis. And then how we analyze this when we're looking at using the asset to buy a business in his particular case is how much will it cost, and then I take my growth minus my cost, and that equals what we call the spread, which can just show me in plain numbers, is it in my best interest or not? And how quickly do I need to pay it off in order to make it in my best interest? So let's take a look here. He wanted to borrow how much? $375. $375 in the first year. I already took a loss of $67,000. Plus, I'm paying loan interest now of $17,850. So if I look at this, here I'm paying interest every year. For the first 3 years, I've got a negative spread. Now eventually, it becomes positive. Why? The reason why is because you pay interest on whatever your loan is. You earn interest on your entire cash value, which includes the loaned amount. Your money keeps on compounding. The insurance company does that by collateralizing the death benefit, and also they offset it a bit by charging you interest on the loan. But the fact that I'm earning interest on everything does help offset the fact and eventually get me out of the red where I've got a positive spread. If I don't borrow anything extra, he plans on using this for his business aside from the initial purchase. That's why he's putting $1 million in. So if he took, let's say, $100,000 the next 2 years, I want to see what that looks like. It's my maximum loan that's impacted when I take these loans. I can look at my spread over here. Let's actually make this more aggressive, shall we? All right, so here we paid in $1 million and we borrowed out $800,000. He has a negative spread, meaning year to year, the interest is exceeding what he's earning for 4 years. By borrowing out 80% of what he paid in. This is really popular with business owners we work with, by the way. What they do is something like this. They're aware of the upfront hit. They're okay with it. The main reason why is because they're earning dividends and interest on this entire cash value. Pretend this is you. You put $1 million into the policy. You know that $1 million is going to continue to compound for you even when you pull it out to use it for your business. So after you put the $1 million in, since you're no longer focused on paying premium anymore, now you can focus on taking money that you would normally pay toward premium, but repay your loan. So then what happens is once you repay the loan, you see that your cash value is restored to what it would have been as if you never touched it in the first place. Now it does depend if the policy is direct or non-direct recognition, but those effects are typically minimal. So let's assume here he takes a year, pays interest only, and then starts to pay it back, principal of $100K per year, which anytime he makes a payment, watch your maximum loan available, see how that's going up? This would happen, and we would run this in an actual illustration with the insurance company too. But that's equity that he can access. He can use it just like a personal line of credit. So now he can tap into it, use it for his business. The big benefit, however, is once it's paid, that cash value and death benefit would be fully restored to exactly what it would have been as if he never touched it in the first place. This is exactly how he plans on using it for his business, and why he's using it for his business is because the money keeps on compounding, and he doesn't have to deal with the bank, the financing costs, the long delays, none of that stuff. So, hope you enjoyed this video. If you did, please let us know in the comments below. You can also reach out to us through our website, ibcglobalinc.com, or you could DM me, preferably on LinkedIn. Thanks so much for watching all the way through, and as always, I hope this helps.